Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. For the next 20 minutes, we'll talk about the ELSS funds. These are essentially the funds which help you save tax. How and why? The rationale and the usage and the kind of funds to bet on. Well, let's get in Morningstar's view on what some of these funds could, on the very topics that I spoke about, Kaustubh Belapurkar needs no introduction. Really, almost every year we've been having this conversation and we are having it yet again. Kaustubh, great having you. Thanks for joining in.
Thanks, Neeraj, and thanks for having me on the show.
And the pleasure is ours, and I hope all is safe. Kaustubh, I know you've always told us that don't start planning about this right at the fag end, but you know how it is, right? Most people do it. So let's start off with what are ELSS funds and how do they help in tax planning?
Sure. So it's always good to set the context. And so, ELSS stands for equity-linked savings schemes. That are essentially diversified equity funds that give you a tax break under Section 80C, up to 1.5 lakhs, for an investment that you can claim a tax break on. And it comes with a 3-year lock-in, right? So basic brass tax that once the money is in there, you can't remove that money for 3 years. But that's great because obviously, when you think about equity, 3 years is probably a bare minimum. I would think about 5, 7, 10 years, from an investing perspective. So from that perspective, an ELSS fund is very similar to, say a diversified equity fund that you would find, your flexi cap funds and, which you would, an investor would typically invest in. A lot of ELSS funds would tend to have a reasonable amount invested in large cap stocks, but, there would also be funds that would, go down the curve and bet in small cap. And there are various types of funds that are available and some great funds run by great managers. But the moot point is that, here's a brilliant instrument that you can use to not only just save tax, but also invest for the long term. Because, the one thing that, I'm glad that we're seeing that what data shows us is that investors are not redeeming their money after 3 years. So they're not trying to flip around. Because clearly, like we said, that, equity is a long-term investing class. We'll have ups and downs like we've seen in the recent times. And that's going to continue. So I think the investors have understood that, this is a great vehicle. There's a 3-year lock-in, but I can stay invested for a much longer term. So I would treat that as any other equity investment fund with a tax break attached to it.
Okay. Can anybody make use of this instrument, or are there restrictions?
It's obviously there's a limit of 1.5 lakhs under Section 80C, and if you have other components that are already contributing towards that, in that sense, it's obviously the effectiveness of the tax break could reduce. But like I said, whatever said and done, it's still it's practically it's a diversified equity fund. So I wouldn't discriminate that against an open-ended which doesn't have a lock-in. In fact, if anything, there are some implicit benefits of the lock-in because like we talk about that the manager just has more visibility on that this money's here for at least 3 years, and I can really put my best ideas and size them up properly rather than having to worry too much about keeping a liquidity buffer within my portfolio. And there's just greater sort of flex for the manager in that sense, which always helps.
Okay. So viewers, a couple of things. So of course, I don't think there is a restriction. Almost anybody can use these products. And two, I think Kaustubh made a very important point that the 1.5 lakh amount includes some of the other components as well. So for example, if you have a PPF or an EPF, and if you are investing in maybe some insurance schemes, etc., then those premia, etc., can be adjusted for that 1.5, and then the remaining, if you use ELSS schemes, then you get the tax benefits. But the larger point is, as Kaustubh said, that these funds might be good independent of the 1.5 lakh limit, simply because they are great products per se because of the fund manager visibility that he spoke about. Kaustubh, are there any drawbacks to investing in ELSS schemes? And then we'll get to some of the schemes and why. But are there drawbacks or points that people should keep in mind before making their investments?
So I think the only drawback, obviously, is like I said, if there is an urgent need for liquidity in the portfolio, this doesn't exist. In this, so for whatever unforeseen requirement that you've planned to invest for a longer term, but you need the money for a shorter term, that's not going to be possible. So I think that's the only potential drawback. But otherwise, I think, like I said, it's at par with the other diversified equity funds, and with the cherry on top with the tax break. So I think that works well. The one thing that investors need to keep in mind, because it's a diverse category, like I said, there will be managers who will be more focused towards large cap, or there'll be managers who will buy more mid and small caps. I think that's what investors need to keep in mind when they're picking an ELSS. How does that fund fit within the context of their portfolio? Because, say, for instance, managers who've held a larger proportion of mid and small caps have obviously done potentially better in the last year or two, right? Given the run up on those counters. So I think optically the returns for some might look great, but you have to, just understand what the construct of the portfolio, the way it will be done, how does it kind of really meet your goals, or fits into your portfolio or not.
Yeah. Also, because the other thing is that while you compare ELSS schemes to normal mutual funds, the lock-in seems harsh. If you compare ELSS to a PPF, then the lock-in is actually not that harsh. It's just 3 years versus some of the others. So keep that at the back of your mind. Okay. Kaustubh, can we talk about some of the funds, and then maybe we'll talk about some other final points, but
sure.
Some of the ELSS funds that you like, and why do you like them? Let's start with one of them.
Yeah, sure. So let me just start from the top for one of our favorites, which is the Mirae Tax Saver. Now this is managed by Mirae Surana, and we think a brilliant manager. And he's been running this strategy, since inception and doing an exceptional job. And when I think about the way the strategy is being run, right, what are the underpinnings of the strategy? So the focus is towards buying quality growth companies, but not overpaying in terms of valuation. So I think that's been Nilesh's underlying focus, where he talks about the margin of safety, that I want to buy good companies which are offering good growth, but I don't want to, I want to have that margin of safety built into the price that I enter at, right? So I think that's what he is looked to plan. And we've consistently seen him do that in the portfolio. And obviously, when you look at the returns and everything, it's worked brilliantly across market cycles. I think the other thing that he does, right, I mean, if I were to look at it, that he's kind of benchmark aware as a manager. So, he won't really go down and say that I'm going to take very large sectoral bets. There will be sectoral deviations, but within a limit, but he's more of a bottom-up bet. So, he'll really look to see which are fundamentally good stocks. And like I said, at attractive valuations, what we call a GARP sort of standard, growth at a reasonable price. Value, he's got a large cap bias, really. Maybe not as much as some of the others that we'll talk about later, but he's still in the range of 60 to 75, which is a pretty reasonable amount of large cap which comes in. And I think it's a diversified portfolio, so it's that's there. And I think broadly it's been run with a very consistent mandate, like I said. And he's been also looking to identify opportunities. In one of the conversations I remember having with Nilesh was, they're identifying something like a healthcare back in 2019, which was a very beaten down sector, but he started delving into that, and that's obviously paid off, for them. So I think, the whole GARP focus with identifying some of these undervalued opportunities has worked brilliantly for the strategy. And obviously, Nilesh as a manager is we regard very, very high.
Okay. And any concerns for this fund? The size, or so I'm not saying size is a concern, but I'm just trying to figure out any concerns at all for this fund?
No, I wouldn't think so. My only concern is that investors should always, like I said, returns should always be taken with a pinch of salt. And the one thing to acknowledge is that every style will go through a period of underperformance, right? And obviously this fund has seen an excellent track record, and there've never been any periods of, but there can be. I mean, every style, there will be a period of the market where your style is not working. What's important is that the manager sticks to their style, and what's important is that investors stay invested, because it's gone. It's not working today, it doesn't mean that it's not going to work tomorrow. That's just a function of the market. As long as the manager stays his course and the investors stay their course. So I think that's what, because investors have, they love this fund, and obviously that shows in, in the assets the way. But be ready that there could be periods where relatively maybe some certain other funds are doing better. But that's okay. That's par for the course.
Okay. The next one, and which is so if this one, viewers, is a gold category, analyst rating gold, analyst rating silver is for Axis long-term equity fund. One, why do you like it? And what's the difference between the gold and the silver rating? It'll help you to elaborate on that too.
Sure. So let me start with what is so the rating systems that we describe are basically a qualitative analysis. What we think about the people who are managing the team, not just the manager, but also the other investment analysts, the entire team, the strength of that, the investment process, which we spoke about. If we think it's being consistently run, and can it help kind of generate alpha over a period of time, and do we see enough proof of the manager stuck to his or her guns over the period of time? Is there enough value that's being added through that? So I think that's what we look to do. And gold and silver in fact, bronze are all positive rating. Is just what we assign as a probability of say that we think that this fund probably has a higher chance of continuing to outperform the benchmark and its peer group over a long-term risk-adjusted basis. But both are positive ratings, both are strategies that we would like. Just the level of conviction could vary. Which that's kind of broadly on the rating system. How does this fund stack up and what's different? So again, this fund is again managed by a very experienced manager, Jinesh Gopani. And again, when you look at it, right, it's a fund that's followed a very constant investment philosophy. Which how is it different from the Mirae one? Here, he's looking at quality growth companies, but he's the mandate is that I don't worry so much about valuations because I think the growth will pay for the valuation. So even if I'm buying an expensive stock today, I think the growth will kind of compensate me for that, and that's really the underpinnings of the way Jinesh manages strategy for a very, very long time. And if you look at it, and and it's important to talk about. So if I was an investor and we spoke about the performance cyclicality, if you see 2021 and year to date has been relatively poorer for this fund versus its peer group, right? But if you see the years of 18, 19, 20 were brilliant for this. And why is that? Because of the focus, like we said, towards high growth, high quality stocks. That is a segment of the market that did really well in 18 to 20. And he stuck to his guns, and worked beautifully. 2021, we know that it's the most cyclical part of the market, which has seen rallies, which obviously is not in favor of the style that he's managing, but that's perfectly understandable, right? When when you talk to Jinesh, a couple of things that beyond his high quality, high growth style, clearly he wants to build a more focused, concentrated portfolio, which is slightly different from the Mirae one, which would be a little more diversified. So it'll typically be between 30 to 40 stocks. He would look to avoid some of those. He typically looks to avoid PSUs or heavily regulated companies or cyclical earning companies where that doesn't really fit into his investment framework. And he's kind of applied that very, very consistently, right? So I think that's the important thing in the way. So in a way, they're slightly different portfolios. There's obviously a little bit of overlap, given that both are quality growth managers. But and again, I think the one thing that Jinesh has done beautifully is that he stuck to his conviction on that. And we've seen periods of underperformance even for the strategy, say in 2016, when we had the last cyclical or metal rally, where he was still holding his high growth, didn't work. But then obviously we've seen the great performance that has been aided by a superior process, which we think Jinesh and the Axis team follows. So I think that's kind of broadly why we have a good amount of conviction. So I would say don't be perturbed about why is this fund underperforming over the recent term. It's just like we spoke about a function of the market side.
Okay. So well, that's with regards to the second fund, viewers, which is from the Axis stable. The third one is from the stable of DSP, the DSP Tax Saver fund. Tell us a bit about this.
Yeah, sure. So this is another interesting sort of strategy and different from the other two that we spoke about earlier, where Rohit Singhania, who manages the strategy, again, very, very experienced manager that we regard highly. But in terms of when you think about the way he's looking to construct a portfolio, one is that he's got a much more fluid approach. He doesn't really worry too much about what the benchmark is. So he doesn't have per se any restrictions in terms of what you would think about where which sectors or stocks were underweight or overweight. So it's kind of a very fluid strategy we've seen him. There'll be a core part of the portfolio. There'll be a tactical part where he thinks that it's super cheap. I'll get in and I'll look to book profits as the price goes up. And we've seen him do that in that sense. So it's the other two were more buy and hold list sort of strategies. With some element of here, Rohit would tend to be a little more on top of kind of switching his positions that you would see. One thing again, what he's looking to do is he's more he goes even more down the valuation sort of curve, where he will look to identify companies which probably are either going through a little bit of stretch or I wouldn't say distress, but basically businesses which he thinks are getting to a rising ROE sort of environment. The cash flows are improving. So kind of early identification of those sort of sectors or ideas that he would do. Again, I think from a capitalization perspective, he's slightly different because he would tend to hold about 1/3 of his portfolio in smaller mid caps. So in that sense, probably higher than where the other earlier two funds were. Again, it's a diversified portfolio, but again, some of his stock picks or sector picks have worked, I think, beautifully, especially the metals call that he took. And he's actually exited some of his positions now, booked significant profit. So I think that's the element that I was referring to, that he can be quite fluid, and he's executed that really well. So I think that's where that's the conviction. The only thing, obviously, with a strategy like this can come increased volatility. So typically what we talk about, the volatility of the market beta can be a little higher for this portfolio. So it can move up greater than the market or fall more than the market, but that's purely a construct again of the way the portfolio is being designed. So I think great manager, a slightly differentiated process the way it manages. So I think another interesting opportunity, for investors to look at. And the reason why I'm trying to bring out different styles is because when I think about from an investor's portfolio, a lot of times what happens is investors don't tend to look at, okay, what is the underlying construct of my portfolio? Am I focused too much, either capitalization or style? When we talk about style, because a lot of investors went into purely growth style funds, in the last couple of years, given that how well growth style had done, right? So everyone thought that this is a space I want to be in. But you want to pad that with different, because like I was saying that, now value a cyclical part of the market has worked in the last 1 year. If you weren't there already invested, then, you might have lost a part of that. So you are rather, mix it up nicely. And, these are various types of funds that can allow you to do it. Look at what you already hold, and then see if you're too overexposed to growth or value. You can accordingly choose a fund that really fits into that whole jigsaw puzzle of your portfolio.
Yeah, makes complete sense, and thanks for that. And it's very interesting that even if this portfolio may be volatile, but because viewers are holding on for 3 years, assuming that the 3 years are not over, that volatility can be digested because there is no option to really react to that per se. Okay, the last one on your list is Franklin Tax Shield. I don't quite hear too many people talk about this fund. How come this has come in the list?
Yeah, sure. And I think so a couple of things have happened over this fund, right? So one is this fund has, there's seen a change in manager. So Anand Radhakrishnan's taken over, I would say retaken over the helm of this fund, a few months back. He used to manage this fund for the longest time, I think up to about 2016, and then they hired Lakshmikant Reddy, who was the manager. And after Lakshmikant moved on from the company, Anand has retaken back the strategy of the fund. What hasn't changed is the core investing philosophy of the strategy. There could be some changes in the margin, but obviously one, we think Anand's, the team at Franklin is great sort of investment managers. What they've done and the style of this has been more tilted towards value, right? So Anand will look to buy, that segment of the market which is going through, elements of stress, or the valuations are pretty attractive, but fundamentally still strong companies. And the same philosophy. The performance of this fund in the growth phase, 18, 19, 20 was pretty, relatively much worse off than the others. But kudos to, Lakshmikant and obviously Anand, they held their convictions. And we see that the turnaround in 2021 is purely because, they didn't try to change the market. They stuck to what their investing style was, more value focused, and they've clearly done that. I think that is which gives us conviction. So Anand as a manager, and the stickiness of the investment process, even through tough times, gives us a fair bit of conviction that, again, this is a great buy. Like I said, if you're very largely exposed to growth style funds in your portfolio, here comes a very good value manager, that you could look to buy in your portfolio.
Okay, well, so and I dare say it was an eclectic mix. So of course, your choices could be very different, but when it comes from Kaustubh and Morningstar, you got to pay credence to the kind of processes that they have when they go about analyzing funds, and therefore this could be a really good shortlist for you if you haven't gotten cracking on your tax saving. Kaustubh, I'll let you have the final word. You always advise that don't start this at the last 2 months of the year. Do it in an SIP basis, right, from the start of the next year.
Yeah, absolutely. I think that's the easiest thing. If you haven't done so already, set it up on a recurring basis now for the next year too. Because, we know markets are the strange animal that, can swing, and you don't want to be waiting till the end hoping that there'll be a market fall or whatever. So just stagger it out. It works best. This is an investment that you want to make to save tax, and obviously as an investment vehicle. So go ahead and set up an SIP today, and let's continue that for at least a few years, so you have reasonable visibility that you're buying your this thing on a staggered basis rather than time to market.
Yes, indeed. Great. Kaustubh, great having you. Thanks so much for taking the time out as always, and stay safe.
Thanks, Neeraj. Pleasure as always.
Pleasure is ours. Viewers, thanks so much for tuning in.